Welcome to our first batch of technical chart interpretations. The concept behind these is to visually put into practice critical elements that you have learned with us in theory. The charts that we use are real chart prices, and this is critical as we show price action as it really is. We, however, painstakingly recreated each chart movement one candle at a time in animation to show you the effect of prices moving in real time, which greatly aids in your understanding of forecasting. We have also provided many different examples. First of all, to emphasize and then re-emphasize certain elements, but also to cover as many variations for you as possible. The first batch here will be dealing with basic trend analysis and major candlestick analysis combined. Once you have completed price action patterns in the next module, we then use the exact same batch of chart pricing, but then we will add all the patterns. This is crucial for us to truly show you how the combination of price action studies starts working together. At the end of the last module, we then actually trade real-life trades to combine everything as it really is, because it's impossible to reverse engineer elements such as Fibonacci analysis and pivot points. We ensured that we isolated the TCIs from the theory videos, as we believe these will greatly aid in your understanding of the theory, and by splitting them, it means that in time to come you'll be able to refer back to them. So take your time when you're going through them and don't rush. Try to test yourself and visualize your theory. They are essential to putting the pieces together, and although they are historical, they are a great place to start. Enjoy! So, Leonardo Fibonacci was a famous Italian mathematician, kind of like the Enzo Ferrari in the world of mathematics. His most famous observations was that of a simple series of numbers from the following sequence of numbers. Here is typically what Fibonacci retracements would look like on a graph. We will get into the depth soon, however, we just wanted to point out that you have a choice of how to display them. Here on the left-hand daily chart, we have them as solid lines, which if seen in isolation works perfectly, which is why we will teach you using solid lines. On the right hand, we have the exact same Fibonacci on the weekly, however using dotted lines. This is commonly used when integrating other studies which have support and resistance lines such as pivot point analysis. And when we get to pivot points, you will see why we start to use dotted lines for Fibonacci.
Okay, let's get right down to it and get an idea of what our strategy is when using Fibonacci.
As a strategy, we will need to try and identify the most recent swing low and high points, and this is where we will be drawing our Fibonacci analysis from. Don't stress, we will guide you later on in some practical demonstrations. For now, to keep the theory simple, let's assume we know the last main swing low and swing high points. We can now study this diagram here and see that if we look at a bullish impulse wave formed from a swing low, then prices start at the low point and end at the high point, being a swing high. Note that on either side, we need to identify relevant swing points and not just assume that the points are highs and lows with little confirmation. Let's take a look at a graphic example of a bullish retracement where prices impulse again once they retraced to 61.8% retracement level.
Here's the same concept, just with a bearish wave with all the possible retracement levels. One important note, however, is that many misinformed traders believe that the 61.8% is the last Fibonacci ratio, which is referred to as the golden mean ratio, only to find prices still go and test the 76.4% and even the 100% level, only to hold and then continue in the direction of the original impulse wave.
We need to define this in a bit more detail so you can get a clear understanding of this. Now, based on depth, we can consider the following in regards to Fibonacci retracement depth. A retracement between 23.6% and 38.2% is regarded as shallow, and such retracements would be appropriate for flags or short pullbacks. The shallower the pullback, the stronger the preceding wave, assuming a continuation occurs immediately after this. Retracements between the areas of 38.2% and 61.8% would be considered as moderate and are the most common. And even though deeper, any retracements beyond the 61.8% retracement level are regarded as dangerous retracements because the more the preceding wave is being put to the test, the less is potential to continue increasing. But remember, the wave is still intact with such deep retracements until the start of the previous wave officially and finally breaks. What is critical is that the second wave is normally confirmed only when the original 100% line, in other words, here on a bullish wave is the highest point, is clearly broken. Only then can a new wave start to be formed. So you can see that Fibonacci retracements can be used not only for break trading using stop orders, but for range trading using entry limit orders, as well as for the placement of stop losses. Using Fibonacci extension levels can greatly assist us in identifying profit limit levels too. But of course, we haven't focused on extensions in the video, but in the next presentation, this is where we'll be turning our attention to. Before we get a bit practical, we'll show you Fibonacci in action on real price action. Now that we have some control over using templates, we need to put it to good use. Having one template with all our favorite parodies within one view is unquestionably indispensable for a skilled trader. First, in order to start building our required profile, we need to close down the 2 gold hourly charts that we formerly used in our dialogue on creating new templates. Further to that, since we are still very much in the learning process regarding other significant windows, we want to bring the terminal window as well as the data window back into view. By using the template drop-down command, we're gonna select our new template for all the charts, starting with the euro. The only other change we want to make on the euro chart is to zoom out, let's say by 3 zoom clicks. Again, as a trick to avoid even repeating the zooming process, we can go back to our template menu, click Save Template again, select our template and save over the template. Now, take your mind back to a previous video, just a while back, where we fast forwarded to a future video whereby we described the importance of US dollar's strength and weakness and how it had influence to other major instruments. Well, this is the exact spot within that future video whereby we had created our preferred 6 trading instruments. We will be readdressing this all-important trading concept in future, so it's not necessary to repeat it here. But finally, just to end off, we will now go straight to the profile shortcut section on the status bar and save this profile as Zero Main Market Watch. There we go. We have entered the 0 on purpose though, just because using both numbers and alphabetical letters will help in keeping order. But well, we'll leave that for next time.